Good morning and welcome, everybody. Thank you for joining us for SVN Capital's 2022 review conference call. Just a little background before we begin. Shree Viswanathan founded SVN Capital in 2018 and launched the private partnership in 2020. SVN's strategy is to find and make concentrated investments in quality businesses across global markets. These businesses are run by exceptional management teams with skin in the game who are achieving high returns on capital and making sound reinvestment decisions. When these companies can be bought at reasonable valuations, the strategy is to purchase and hold. So just a few more housekeeping items. First, please be advised that this presentation is for informational purposes only. It is not intended to constitute a sale, solicitation, or advice. I highly encourage accredited investors wishing to learn more about SVN Capital to reach out to me separately. Always happy to connect. So today, Shree is going to offer his perspective on current market opportunities, as well as discussing some of SVN's portfolio holdings, including the promising recovery we're seeing in this first quarter. So after his presentation, we will open it up for questions and answers. You are very welcome to submit a question through the chat feature or raise your hand, and I'll be happy to unmute you to ask your question live. So with that, I'll hand it over to Shree.
Thanks, Jessica. Good morning, everybody. Thanks a lot for joining the call today. It's slightly less than a month since I released my year-end letter. Hope you've had a chance to read it. Anyway, I thought it would be a good time to get on the horn and answer some questions and concerns people may have. So today I will present my prepared remarks over the next 15 to 20 minutes. After that, I would be happy to answer any questions, and I want to be very respectful of your time. And so we'll wrap this call in an hour. I would certainly be more than happy to answer questions beginning tomorrow. So here's the agenda for the day today. While I don't make investment decisions based on macro, based on my conversations with a number of you and others, other friends that I've discussed this with, there seems to be a lot of angst about the macro. And so that's where I will start today. And then I'll provide a little bit of color on the portfolio itself, followed by some updates from a few of our holdings, and then wrap up my prepared comments with the question, is this a good time to be invested? So with that, let me get started. There is no beating around the bush. 2022 was a tough year. There was no place to hide. S&P 500 total return was minus 18%. NASDAQ was down more than almost twice that. Almost all equity markets around the world, around the developed world particularly, were down. And interestingly, the bond market was down just as much as the equity market. Now, that doesn't happen very often. In fact, the last time it happened was back in the 1960s. So in 2022, the only two areas that had positive returns were energy, which was up big, and cash. Neither one of those two areas are of interest to me. First, cash, and I like to remain fully invested. I'll come back to that in the latter part of this presentation. And energy, oil and gas companies, and even the suppliers to the oil and gas industry, they don't meet my criteria for long-term ownership. So we don't own any, and I doubt if we will ever. The box in the right bottom of the page shows some of the major reasons for the market performance in 2022. The big one being the war and inflation and interest rate. So back in November 21, inflationary pressures had started building up. And then when Russia invaded Ukraine in February of last year, That was the proverbial straw that broke the camel's back. Energy prices shot up, and central banks were forced to address the inflationary pressures, meaning interest rates went up, which has led to where we are today. We're left wondering if the economy will slip into recession or not. So where does 2022 stand in a historical context? Sorry about this busy page with a lot of numbers. Let me try and explain the significance. This is a table showing S&P 500 returns over the last 95 years, going all the way back to 1928. I think there are at least a couple of interesting observations. First, more than 70% of the past 95 years, the market was up, which is shown in green. Second, and this is an even more interesting point, which is the column under drawdown. It shows every year S&P 500 had an intra-year decline. That's what is called as drawdown in this table. But the interesting point is every year over the last 95 years, the market has had some sort of a drawdown. Sometimes it was just a few percentage points. And in certain other years, like in 2022, it was a lot more. So for example, 22 was a tough year, total return was minus 18. But during the year, the index was down as much as 25%. Similarly, in the year 2020, COVID hit year 2020, the index was down as much as 34% early on. But then it recovered, and for the entire year, the market was up 18. And finally, another example would be 1987. A few of you on this call would remember the Black Monday in October of 87. Index was down 34% soon after. But for the year, it was still up 6%. So one major takeaway from this slide is not to panic during these inevitable declines during the year. In a couple of slides, I'll show you why it's even more appropriate for our high quality portfolio. Finally, let me share what Howard Marks wrote in one of his recent essays. Howard Marks is a phenomenal thinker, an author. He's also an investment manager. He recently released a note titled, "What Really Matters?" In it, he said, it's clear from observations that security prices fluctuate more than economic output or company profits. What accounts for this? It must be the fact that in the short term, the ups and downs of prices are influenced far more by swings in investor psychology than by changes in companies' long-term prospects. I think that phrase, swings in investor psychology, is the most important part of that statement. Here's another big name CEO in the industry, Steve Schwarzman, founder, chairman, CEO of Blackstone. In his most recent earnings call just a few days ago, he said he's been through several cycles over the last 50 years. And in his observation, these types of market declines don't hold up. The resumption of historical trends will ensue soon after. So at this point, you may say, yeah, that's all fine, Shree, but that's about the market. How about your portfolio? I would say that's a good question. That's where that's why I wanted to share a little bit about our portfolio statistics. I'm here to tell you that we have a high quality portfolio, far superior than the market. And this table shows some of the most important metrics in evaluating the quality of a company or quality of the portfolio itself. These metrics that I show for our portfolio is in weighted average terms. The most important metric here is the return on capital. And our portfolio is more than 20% for, as of the year 2022. But such high returns is not much use if the business is not able to grow and deploy more capital at these rates. That's why the free cash flow growth is an important metric. And there again, our portfolio was up more than 20%. Finally, our portfolio companies have little to no debt. This becomes evident in the total debt servicing cost as measured by interest coverage ratio. Again, it's a far superior metric than what the market offers. So I go back to my statement from my letter, which is over time, stock prices should reflect the quality of these businesses. And next, I'll go through a few of our holdings pretty quickly, and then I can answer some of these if there are questions in the Q&A part of it. A couple of these companies have announced earnings recently. And the first one is Old Dominion Freight Line. They just announced earnings last week. This is a less than truckload trucking company with the second largest market share in the industry. Couple of interesting points about this business are, number one, this is a company that for a long time has had the strategy of owning the real estate on which their service centers are located. And that ownership of real estate has helped them tremendously in the past, but particularly in this recent inflationary period, it was a significant positive. And the other important point is this is a trucking company with non-union labor. Both points become evident when we look at that column titled operating ratio. This is essentially the cost of running the business. And this is the only company, even though there are several thousand trucking companies and a few hundred less than truckload operators, this is the only company that currently runs a business with operating ratio in the low 70% range. In fact, in the most recent call, they said it's likely that they will have a year-end number that's with a 6 handle, meaning in the 60-some% range for the year. And that's what translates into these significant earnings growth and free cash and return on invested capital. There's been some speculation about economic slowdown and the possibility of a recession, but this management has continued to execute at a very high level. Overall freight volume was down a little bit during the year, but again, they gave an update saying beginning spring of 2023, they expect the volume to go back up. So that's number one. The other company that just announced is Evolution AV. This is the world's largest supplier of live casino games to operators like FanDuel and Bet365 and many, many others. One of the most important areas of focus for me is competitive analysis. Competitive edge is what allows some of these great businesses to continue to generate healthy returns over a long stretch of time. So one of the most important points that I took away from the earnings call last week was Martin Carlson, the CEO. He said the distance between Evolution and its competitors is only increasing. This is a company with more than 70% market share in this business of live casino games. It's a large player in the US, even though within the US, only 5 states have opened up live casino. But there are a number of states that have the legislation in place and is likely to open up soon. And so both Old Dominion and Evolution, the stock went up 10% on earnings. It was just a reflection of the strong performance, not just the strong performance, but also what they expect to happen going forward. And the other company that I wanted to discuss or at least highlight is Copart. They haven't announced earnings yet. But the reason why I wanted to highlight was back in November last year, Ritchie Brothers, an industrial equipment auction company, announced the acquisition of IAA. IAA is the primary competitor to Copart. Copart already has more than 50% market share. And should this deal go through, which I think is in jeopardy at this point, but should this deal go through, I think Copart is likely to benefit even more. The reason why I say the deal is in jeopardy is some of the shareholders of Ritchie Brothers have written to the board asking them to nix the deal. For example, Lux Capital, one of the shareholders, wrote a very detailed letter in which they cited that IAA is actually a weak player and has lost more than 25% market share over the last 6 years, presumably all to Copart. Again, competitive edge. And sometimes in some of these businesses, while the management team is making decisions every day, just a few important decisions made over a long stretch of time, comes back to benefit the operation, far into the future. In this case, for example, Willis Johnson, the founder of Copart, back in the early 90s, he decided that Copart should own the real estate of these salvage yards. And in 2003, Jay Adair, the current co-CEO, who's also Willis Johnson's son-in-law, he decided that Copart should auction all these vehicles online instead of running them through a brick and mortar location on their salvage yards. Both decisions have come back to benefit this operation tremendously. In fact, during COVID, this online auction essentially meant Copart was able to run its operations seamlessly, as opposed to IAA, which was running brick and mortar auctions, had to reposition and operate online through those COVID impacted months. So the point here is, again, this is a high quality business with a large market share, management team executing at a high level. At this point, this is still early in the earnings season. I'm happy to see the strong operating results from our portfolio companies and stock prices reflecting such strong returns, which in turn has led the portfolio to generate strong returns over the last 5 weeks of the year. Is this a good time to be invested? I say yes. It's true that you don't want to ask a barber if you need a haircut. Well, I don't have a problem like that, but it is true that you don't want to ask him that question. But I sincerely believe that this is a great time to be invested in high quality equities, particularly for the long haul. Here's a chart from Bank of America. This chart shows the large asset allocators are sitting on record amounts of cash. I think Buffett's dictum that I list on the right side of this table is very appropriate here. At SVN Capital, I remain fully invested, and currently I maintain a little less than 2.5% in cash. I remain fully invested because of this additional chart, which shows that if you missed the 10 best days in the market, your returns are likely to be cut by more than just about 50%. And so from my standpoint, I think it is important to be in the market as opposed to timing the market. And so with that, let me just wrap it up with my investment criteria at SVN Capital. It's always a matter of answering 4 important questions before I deploy capital into any one name, irrespective of where it's located. Is it a company that I can understand? The proverbial circle of competence question. Is it a business that generates not just high return on incremental capital, but also has great opportunities to reinvest at similar rates? Is it a business run by honest, competent management teams with skin in the game? And is it available at a reasonable valuation? So that continues to be the investment criteria. With that, I'm currently evaluating a couple of different opportunities: an insurance company, specialty insurer here in the US, and a couple of luxury products providers in Europe. I'm scheduled to go meet the CEO and the management team of this insurance company later this month. I'll give you an update, hopefully in the mid-year letter. But at this point, I remain very optimistic about our portfolio, the opportunities set around the world. And with that, let me see if there are any questions, and we'll be more than happy to answer them.
Great. Thank you, Shree. As a reminder, please feel free to raise your hand and ask a question. All right. I see one of our guests, KK, has a question. You want to go ahead?
Yes. Hi, Shree. Thanks for the thanks for your presentation, and I wish you all the very best in your portfolio as well. So I've got one question actually. I've recently seen, like, in your Twitter feed that you said like you might also look into some of the firms in India as well. My only question to you would be is actually obviously with the clean accounting and other stuff, what type of steps that you do to make sure you pick the best companies by using some kind of like a clean accounting? Because I see you're mentioning your investment criteria, quality and other stuff, right? So is quality is also part of clean accounting as well? Thank you.
Absolutely. Accounting is the language of business. Absolutely. So thanks for your question, KK. But you know, in my investment analysis, one of the important questions I have, even though it's a global portfolio, one of the important criteria I have is, does the company follow an accounting regime that I can understand? There are several different accounting regimes around the world. Obviously, in the US, we follow generally accepted accounting principles, and much of the rest of the world follows International Financial Reporting Standards, IFRS. But in addition to that, there are country-specific accounting regimes. For example, Malaysia has Malaysian GAAP, Mexico has Mexican GAAP, in addition to IFRS. And so when I'm looking for opportunities to deploy capital, I'm looking for countries and companies that follow either one of those two regimes, US GAAP, which is only in the US, or IFRS. But then beyond that, I also overlay a few other constraints. Number one is I want to be in geographies where I personally can understand and appreciate the IP laws, the governance structure. While there is absolutely nothing wrong with, say, for example, Mongolia or Nigeria, I personally do not have an edge in those regions. And so I avoid many of those countries that I personally cannot see IP laws or governance laws that are comparable to the West. And then another constraint is I want these companies to be filing their financials in English. And so with all those constraints, overlaid on top of each other, at this point, I remain invested in the US, which is the biggest piece of the portfolio, just about a little north of 50%. And then mostly in developed Europe, Sweden, Poland. I also have a small position in a company in Israel. So yes, accounting regime is an important aspect of my investment criteria. But specifically with respect to India, India also follows IFRS. I'm not currently invested there. One of my important allocations of time here is to spend a lot of time on the existing portfolio, but also continue to look for interesting opportunities. At this point, at a macro level, India is a phenomenal country to be looking at. 1.5 billion people. They just crossed China as the most populous country in the world. But the most interesting aspect is more than 50% of the population is less than 25 years old. That by itself gives a phenomenal opportunity for great businesses to offer their products and services. The administration has taken a few important steps in opening up the country to benefit the entrepreneurial community. And so I see a lot of younger people who have been educated outside India going back and opening up businesses. I recently was in Dubai, met a few of those entrepreneurs who have been educated in institutions like Princeton and Cornell, have gone back to open up their businesses. At this point, they're private, not interested in those private opportunities. But the fact remains that there is a reverse migration happening, and all happening because the country is offering some tremendous opportunities. At this point, I'm just looking at a number of different options. As I mentioned, my investment criteria remains the same. It has to be a company that I can understand, has to be high return generating and high reinvestment opportunities. And management, particularly in a country far away from here, like in India, I want to be 100% certain that quality of the management team is extremely high. Before I deploy capital, I will be sitting across the table. I would love to see the white of the eye before I deploy capital. And so I'm far away from investing in India, but I'm very interested in it.
Thanks, Shree. We had a couple questions come in as well. First one, please define what you feel is long-term.
Yes. So the way to address that, the way I've thought about this is 1 year is, a calendar year is relevant only from agricultural products standpoint. Yes, that's how long it takes for the earth to go around the sun. But as far as a business is concerned, the business cycle is about 5 to 7 years. So it's got to be at least that. And history tells us that the longer the time frame you remain invested, particularly in high quality businesses, the better the outcome. And so without necessarily specifying an exact number, I would say long-term is at least more than 7+ years.
Okay, thank you. Question on evolution. Can you expand on Evo and how Todd Halsalter might see the game expansions through acquisitions and how the slot business might improve?
Sure. For those that are not very familiar with this business, just a quick background. Evolution, as I mentioned, is the largest live casino provider. Live casino is essentially offering all the games that are offered in a traditional casino, like blackjack, roulette, baccarat, and many, many other games. But all that is done online, and particularly with a live dealer behind the camera. So any one of us can log into a particular provider's website and play one of these games, provided you are in a geography that allows these games to be played. So here in the US, Michigan, Pennsylvania, and New Jersey are 3 big states. And in all 3 states, Evolution offers these games. So that's the background. That's on the live side. And they also offer traditional slot games. And these slot games are, a lot of other players also offer such slots, but these again are offered online. Slots are a much smaller piece of the pie as far as Evolution is concerned, but they're trying to grow that business. In both areas, particularly on the slot side, they've made acquisitions recently, and they continue to look for opportunities. In fact, in the call on Friday last week, they mentioned their primary focus is on organic growth, but when opportunities pop up, so for example, last year they made an acquisition of a company called No Limit City. It offers very interesting slots games. They've now incorporated No Limit into Evolution's primary platform. And as we speak, in fact, it's a relevant question because as we speak today, Evolution is offering all its games at a big conference in London called ICE, ICE. I don't remember the exact expansion for it, but Evolution is a big participant in that conference. And this year, last year, for example, they said they would release 88 new games, and they accomplished that. This year, they're planning on releasing 100 new games. 15 to 20 of them will be on the live side, and the balance will be on the slot side. So yeah, Todd Haushalter, he is the chief product officer. He's an American who was the operations head at Bellagio in Vegas. He joined Evolution back in 2015, 2016, has been the primary lead in terms of coming up with new games. And I expect them to announce some very interesting games on both sides later today. And this is, again, a company with very little competition, 70+% market share, no debt on the balance sheet. EBITDA margin, EBITDA is earnings before interest, taxes, depreciation, amortization, which is essentially the cash flow proxy. That margin is approximately 70%. I haven't seen too many companies in my experience that organically grow at 30, 40 some percent a year and are able to generate 70 some percent EBITDA margin. Here's an opportunity. And for all that, the company is trading at I believe, a very attractive valuation metric. Hope I've provided some color relevant to your question and something more as well.
Great. We have a few more questions that have come in. Shree, given the fast start to the year we've had, the above average possibility of a recession in the near term, and the inevitable pullbacks that occur almost every year, how does this impact your sense of urgency in investing in new ideas or adding to existing positions?
Sure. I think that's a very nice question. The answer would be, I would respond that based on the time horizon. For particularly these types of, I showed you that more than 70% of the years when, going back to 1928, S&P 500 was up, was in the green. And given the kind of high quality portfolio that we've got, I believe we are likely to perform even better. I'm not saying that we need to be invested for 95 years to see that kind of a return, but over a long stretch of time, our portfolio is likely to do a lot better than the market. And so even though there is a question about recession and possibility of a recession and a slowdown and increasing interest rates, if we take a fairly long-term approach, for example, Evolution, or for example, Copart, these types of businesses are likely to continue to see consistent growth. And the most important factor would be the time horizon. And if that's the case, what is happening in the near term would translate into an investment opportunity as opposed to anything else. I wouldn't necessarily rush into the names just because the market is down, and I wouldn't necessarily defer just because there is some question about a possibility of a recession. I'm reminded of Peter Lynch's statement. He said, there is more, historically speaking, more money has been lost waiting for a correction than in the actual correction. And so I would continue to take the same pace, same approach. I'm looking at a couple of interesting opportunities, and there wouldn't be any major change to how I approach the portfolio.
The next question is a great piggyback on this one, on the previous one. You mentioned that you're looking at an insurance company in the US, as well as cosmetic companies in Europe, but you also mentioned that you're only holding 2.5% capital. Should these companies meet your investment criteria, do you intend to raise more capital, or will you reduce your holding in some companies to fund the buying? If the latter is the option you will take, how do you decide what position to reduce?
Yeah. Another very important and relevant question to the portfolio itself. So at this point, the largest position, which is Evolution, is a little north of 15% of the total portfolio. I have 10 names in the portfolio, and the top 5 account for close to 65 to 67% of the total portfolio itself, which also means there are a few positions with lower weights. Lower weights primarily because of the quality of the business, or the competition, or the management team's execution, or the valuation. It's a combination of a number of different factors. I've always said that I would like to run this portfolio with a very concentrated collection of high quality businesses, 10 to 15 names, more likely closer to 10. And as a result, if I do find one of these companies very interesting, I will end up selling 1 or 2 of these lower weights within the portfolio to develop a weight in one of these 2 new names. Keep the cash, again, pretty close to where it is.
Not to say you're not raising capital currently,
Yes.
and we are accepting new investments, of course, investors into the partnership. Speaking a little bit more to some of the global qualities of the portfolio, Shree, to what extent have the currency moves hurt or helped the portfolio?
Yes. So yeah, just about 50% of the portfolio is in the US. Which means the balance is in Sweden, Poland, and Israel. Soon after the war started in February of last year, most currency markets kind of congregated towards US dollar or even Swiss franc. And as the dollar strengthened, particularly for the first 6, 7, 8 months of last year, I did feel the pain of Swedish franc or Swiss franc and Polish zloty depreciating against the dollar. But over the last few weeks now, as the Fed has kind of eased up on interest rate increase, or as the world has realized that Europe is not going into an energy Armageddon, those currencies have improved a little bit from where they were. So at some point during the year, both currencies were down as much as 20+%. At the end of the year, for the full year 2022, zloty was down as much as 8%, close to 9% maybe, and the Swedish krona was down about 12%. So it was a little bit of a headwind for the portfolio. Having said all that, I don't hedge the FX risk for a few different reasons. Number one, currency market is a very fickle market, moves very, very quickly. And number two, more importantly, these businesses, management teams of these businesses, they hedge their own exposure internally. So sometimes if I take an additional hedged position on these stocks, it may actually counteract what the management team is doing. So for example, Live Chat, which is one of the portfolio holdings, a software company based in Poland. It's based in Poland. More than 50% of its revenue comes from the United States, from North America. They do business in 130 countries. But they collect 100% of their revenue in US dollars. Or take Copart, for example. It's a US-based company. They do business in more than 70 some countries. And so, over time, these types of currency moves will offset each other, and any sort of additional layering by my efforts to counteract those effects will sometimes be an overall negative to the portfolio. So I don't hedge the FX risk. So it was a little bit of a headwind, quite a bit of a headwind in the early part of last year, eased up a little bit. It was still a sort of a negative for the overall year, but I expect these currencies to revert back to where they were over time.
Well, Shree, I'm going to give just another minute here for any last questions to be submitted in the meeting, or feel free to raise your hand. I can unmute you. It's been great participation. Really appreciate the flow of questions. All right. So seeing none, want to again extend our appreciation for everyone's participation. Thank you so much for joining us. And if you have any questions and you would like to set up a meeting with Shree and myself, please feel free to reach out at jessica@svncapital.com. Thanks so much and have a great day.
Thanks a lot, everyone.
Thanks, Shree.
Appreciate that. Take care.